Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay. So now you can download the slides from the model. So what I want to talk about today is the short constraints and behavioral biases in asset price models. We'll see how far we can go about the behavior bias. Maybe we'll continue to talk about on Thursday. So last week we talked about information asymmetries, right? Information asymmetry is, everybody that's on the market may get different signals. Some signal may be public, some signal may be private, so you can have a different signal structure in the market. So the question there is two issues. One is, does the price actually incorporate all the information, right? Then if the information is symmetric, how would actually that affect people's tradings? So similar to the information asymmetries, you can have heterogeneous beliefs. Maybe this is coming from the different signals. So investors have different beliefs about the probability of the payoff. Right? So the question is, if you have different beliefs, like how do we actually model it in a very simple way? So what I want to introduce is to introduce you to a very simple way to actually model this when people have different beliefs. And one thing you will see at the end is that if people have different beliefs, now the short sale constraint will be really, really important. It's possible that the asset price will be actually traded even higher than what the fundamental value actually dictates by either one's belief. So let's look at a very simple model that have only just two states. Let's say this state is summarized by the dividend payout, right? So it's either dt equal to 0, which means there's no dividend, or dt equal to 1, that means the dividend payout equal to 1. Okay, very, very simple model. And we have constant discount factor, let's call it gamma. And everyone is actually risk neutral, so you don't actually have the complication of the, the risk aversion here. So given this, there's only two states. The probability of the world will depend on four conditions, right? So it's either the probability of the world is either you start with d equal to 0, go to d equal to 0, or start with d equal to 0, you go to d equal to 1, or you start with d equal to 1, or go to d equal to 0, and d equal to 1 to d equal to 1. So it's 2 by 2 matrix. That can actually summarize the probability of what's the t plus 1's state of world conditional on the information you get at t equal to at dt. All right, so for example, in this matrix, you can see that each row, so the top starts with 0 and 0, and bottom starts with 1 and 1. All right, so each row will dictate the current state. So the top row is all start with current state equals 0 and going to either 0 or 1. So bottom is either starts with 0 and going to 1, 0 and 1 again. And the column will denote the future state. So such a matrix is sometimes called transition matrix. So it actually tells us the probability of how the world actually will end up. All right. So the first thing we can do is to actually calculate the present values, right? Which actually, hopefully, it's very easy to do for you guys, right? So what is the expectation of d plus t conditioned on the dt information? Well, that's very easily dependent on what my current what my dt plus 1 payout is and what the probability is, right? So if the dt plus 1 payout 0, that probability equals to dt plus 1 equal to 0 condition on dt, plus if the dt plus 1 equal to 1 times that probability, which is dt plus 1 equal to 1 condition on dt. All right? And if you put these expression, the conditional expected dividend value, this is just your transition matrix Q times this payoff 0 and 1. All right, so if you take this transition matrix and times the payoff 0 and 1, so this will be starting with this row. If you times 0 and 1, so the only one part, so only the second part actually is going into this equation, all right? And if it's Q equal, the second row also, it's only the second part. So it's only the second vector, second column here with the payoff that matters, all right? So if you can, again, you can see this is basically this probability, and this probability is just the second column, and the payoff is either 0 or 1. Right? So that's actually quite easy to do. So this is only one period. If we want to do it for multiple periods, you do it again, right? Expectation of dt plus 2, condition on t plus 1. What essentially we are doing is you times this conditional probability Q in the front again. You just have the transition matrix once again. So for any conditional expectation of dt plus I, the present value will be just Q to the power of I times this payoff vector 0 and 1. All right. So if I buy my stock today, what is the sum of all the future payoff? Well, if my payoff today, the sum of future payoff with the discount rate gamma is just the sum of all the dt plus i's, and that will be equal to the first period, which payoff is Q times the vector 0, 1. So first future period, I need to discount it once. So this is the gamma times the Q. The second period will be Q squared times 0, 1, and I need to discount it twice. So that will be gamma squared, and etc. Right? So this is an infinite sum, right? And we can actually use the formula. The initial value will be gamma times the Q, right? And the factor is, if you remember, 1 over 1 minus growth rate inverse, right? So here the only difference is here Q is actually not a number, it's a matrix, right? So instead of 1, you need to use I, identity matrix. All right, so this is the I minus gamma Q inverse. It's the same as the formula we get when this Q is a scalar. Okay, so now we know what's the sort of the future payouts, the present value of all the future payoffs. Now we can calculate the value of the stock, right, or the value of the assets, because as you learned the way before, the value of assets is just all the discounted future values, right? So now let's calculate what's the value of these payoffs. So to actually calculate that, let's see what the Q is first. Let's say you have two investors, A and B. They have the same discount rate, so gamma equal to 0.75. But their Q, which is their probability transition matrix, is different. Right, so QA, the first person, has this matrix of half and a half, 2/3, and 1/2. Remember, this is from 0, 1, 0, 0, 0, 1, 1, 0, 1, 1, right? And the QB is 2/3, 1/3, 1/4, 3/4. So this is called a belief because this is the subject transition matrix, right? So these two persons have different matrix, different beliefs of how the world will actually evolve, okay? So if this current state is D equal to 0, right, which one is more optimistic? Why the first one?
Probability is higher.
Probability is, so the first one probability is what?
For the 0 to 1 is higher than the second.
Yeah, so what's the probability of the first one's probability from 0 to 1? 1/2, right? So this is 0 to 1, 1/2. And for investor B, his probability from 0 to 1 is 1/3. Right? So the first one have a higher probability, so he is actually more optimistic if your starting point is D equal to 0. Okay? And if your starting point is D equal to 1, then the second one is more optimistic. Right? Because the second one, if it's starting 1, the second one has probability of 3/4 versus the person A has probability of 1/3. Okay? So depending on the states, they have different views about the world. Right? You can, think about this, depending on, for example, current market is really low, what do they think about whether the market will actually go up? Or the current market is really high, whether do they think the future market will continue to be high, right? So although we model it as a stock with dividend payout, but you can use this to think about the situations in the market. Will be the same. Right. Okay, so now we can calculate the fundamental value or value of this stock, right? As we said, if you look at this formula, this is just gamma Q times I minus gamma Q inverse times this payoff vector, 0, 1. So let's use this to the two persons. So for person A, gamma is the same 0.75. Q is just this QA, right? And you plug into the formula and let the computers to actually calculate. So this is the QA, this is the QB, and the D is the matrix 0, 1. So you plug in this formula to have gamma Q dot inverse of I minus gamma times QA dot D. That'll give you vector value of A, which is a vector 1.33 to 1.22. So that's how these two numbers actually coming out. All right? So you notice this is actually a valuation vector because it depends on what the state is. Okay? Now, what about investor B? Well, investor B the same. So if you plug in the formula, you have a vector of 1.45, 1.91. So each of them has a valuation depending on the state of the world, and their valuation are different because they have heterogeneous belief, right? Because they believe the world will evolve according to different probabilities. So the question is, what do you expect to actually observe of the price of this asset? Well, price will also apparently depend on the state, right? Because the valuation is depending on the state. Right, so if it's state 0, this is the 1.33 valuation for A, and valuation for B is 1.45. So what is likely to be the price of valuation, price of state 0? Can that be 1.33? Or should that be 1.45? Or should that be something else? Well, if this asset, if state equal to 0, is selling for 1.33, and you're agent B, what do? You just buy it. You raise the price, right? You say, oh, this is the 1.33, this is so cheap, I'll buy as much as possible until the price increase. Okay? And at what point he will actually stop buying? To 1.45. He'll say, oh, that's my valuation, I'll stop buying. Okay? So it looks like all the prices will be determined by agent B, not agent A, because agent B have a higher valuation. Right? So the question is, what this valuation by agent B, 1.45 and 1.91, would that actually be the equilibrium price? Right? So the question here is, does this mean that investor B will always hold the stock and the price will equal to his assessment of the fundamental value? The answer is no. Right? So we can see that why the answer is no. Let's suppose where's our starting point? The starting point is price equal to 1.45 and 1.91. That's investor B's valuation, right? So if this price is 1.45 and 1.91, investor B is satisfied. But what about investor A? Well, you will say investor A has a valuation is much lower, right? But he can actually still play around these two prices to get the actual profit. What he will do, what he can do is to buy this stock in state 0 and sell it in state 1. So if he buys in state 0 and sells it in state 1, his expected payoff will be so 0.775, that's gamma, right, times the probability of state 1, which means you get $1 dividend, right? And this probability is for investor A, that's a half. Remember, investor A's probability is a half and a half if the state is 0. Okay? So this, everything he's buying from state 0, so all his probability is starting from state 0. Right? So it's either 0, 0 or 0, 1. So the probability of 0, 1 is a half with a payoff 1. So if the first period pays out that, that's fine. But what about if the first period doesn't end up the state 1, he doesn't sell it, right? Now he needs to sell it in the t+2 period, and when the state equal to 1. So what's that probability? So the probability of state equal to 1 in the t+2 period is that 1/2 square. Right? Because it's 1/2 will be 0, 0, and next one will be 0, 1. So 1/2 times 1/2, so that's 1/2 square, and the payoff is 1. And all these, that's all the probabilities, right? And all the payoffs is, if state equal to 1, I can get the dividend for $1, remember? And I can sell the stock for that price, 1.91. So if you calculate that, that's 1.75, and I think the calculations here. Right, so you have initial, that's what the initial value is, and then you have multiplier with the probability equal to 0.5. And if you calculate that, that's 1.746. So that's where this 1.75 comes from. Right, so we just showed that. Remember what we show? We show that if the price of this asset is, so this is the state price, right, is 1.45 and 1.91, then investor A can buy the stock in state 0 and try to sell it in state 1, and his expected payoff is 1.75, which is higher than this price of 1.45. So investor A will definitely try to do that, which means the price of this stock in state 0 will no longer be 1.45. Because his valuation is higher than 1.45, he will try to buy this stock at 1.45. Then you ask, well, now let's just raise this instead of 1.745, let's raise this to 1.75. See if that actually is equilibrium. All right, so if this is 1.75 and 1.91, well, investor A is satisfied. What about investor B? I'll claim that the investor B will try to buy in state 1 and sell in state 0. So why I would claim investor B will try to buy in state 1 and sell in state 0? Remember, when is actually investor B more optimistic? It's in state 1, right? If you look at this, in state 1, he is 3/4 instead of 1/3. Right? So in state 1, he's very optimistic. So if it's state 1, he'll try to buy it because he's optimistic about the future payoff. Right? So he tried to buy it when he's optimistic, which is state 1, and sell it when state 0 occurs. And that payoff will equal to, so the first period will be gamma discounted with his probability is now 1/4 and 3/4, right? And the price is 1.75 in state 0, and in state 1, I get the dividend 1. Right, and if the second period, then I have r squared. So at first it's 3/4, and then the second period is 1/4 times the price 1.75, and the probability in the second period will be 3/4 times 3/4, and you got payoff 1. That's the dividend. So if you calculate these, you get 2.03, which is still higher than 1.91. So if you want to see the calculation, this is the initial value for investor B, right? So probability is 1/4, 3/4, and the payoff is either 1.75 or 1, and the discount value is 0.75, and the multiplier is 1/1 minus 0.75 squared, and you got this payoff 2.035. All right, so the highlight we got is that even if at the beginning we think because investor B have higher valuations and this price should be determined by investor B, 1.45 and 1.91, because of different beliefs, investor A is not actually satisfied with 1.45 price. Right? And he'll have the strategy of buying state 0 and selling state 1 because investor A is more optimistic in state 0. And even if we raise this price to 1.75, now investor A may be satisfied, but investor B is not satisfied because he will buy in state 1 and sell in state 0 and get the payoff 2.03, which is higher than the price 1.91. So now we have a situation that the market price in each state must be higher than either 1.45 or 1.91, which is actually the highest valuation by either of the investors in either state. Right, so what is actually a consistent way to actually price this stock, given the different belief about probabilities? So the price should maximize the expected payoff for both agent A and B, investor A and B, conditional on the DT, the information you have today. Right? So this future payoff will be gamma times dt plus 1 if this is getting the dividend payoff equal to 1, and it should be equal to gamma times the price of dt plus 1 if this actually does not pay out dividend. All right, so in this example, the price of D equal to 0 should be equal to gamma 0.75 times the maximum of this thing, gamma dt plus 1, gamma p dt plus 1, right? So that will be, gamma is already taken out of the maximization, so that will be dt plus 1 times p dt plus 1. So if it's D equal to 0, the probability is half-half for A, right? And if it's not payout, so this will be P0. If D equal to 0, then this is P0. If D equal to 1, this is you pay out dividend equal to 1 plus the price of D equal to 1. That's for agent A, right? So for agent B, he has different probabilities. His probability is 2/3, 1/3. So it's 2/3 times the P0, that's D equal to 0, and the 1/3 times the payoff, which is dividend 1 plus P1. And that will be, this maximum will be P0. P1 will be equal to gamma times the maximum of agent A, which his probability is 2/3, 1/3. Again, the payoff will be P0 and 1 plus P1. And for agent B, his probability is 1/4, 3/4, and the payoff will be P0 and 1 plus P1. Now we have two equations, and we are trying to solve P0 and the P1, so we have two unknowns. Two equations, the two unknowns, we can solve it with some linear programming. So that's P0 equal to 1.846, P1 equal to 2.077, which is both higher than 1.45 and 1.75 and higher than this 1.91. So in this situation, the price actually exceeds the fundamentals or the fundamental payoff we calculate with the discount to the future dividend that perceived by either of the investors. It's actually higher than even the optimistic investors. Why is that? How can the price be actually be higher than either A or B? What do you think? Isn't that kind of weird, right? So this is why, mathematics is important, right? Because if we are not doing math, then we'll say, oh, maybe we made a mistake somewhere, right? But we are doing math, the number is there, it's higher than what we actually think they each value. So what can be the issue? If you notice, everything here is long. There's no shorts. Right? You can either buy the stock and sell it in the future at day 0, at the D equals 0, or buy it and sell it in the future at D equal to 1, but you cannot short. You cannot, without owning it, and borrow the stock and short it. So there's no short, so there's essentially actually short sale constraint. Right? So while in the short sale constraint, so the upshot is with the short sale constraint, the market value can be actually much higher than any of the investors think in the fundamental values. Right? In other words, we can call it quote-unquote bubble. It's deviation from the fundamental value. And this deviation is for any of the investors, right? So fundamentally, why this deviation can occur? Aside from, you can't short, everything's long, what's the sort of the story behind it?
The people want to short the stocks, they don't participate in the market. Only the one who want to buy, they keep buying and push the price up.
Yeah, but why the price actually will be higher than even his value? Regulation? There's no regulation here, right? Okay, so we have only two investors, right? Investor A and investor B. What does investor A think of investor B? He'll think investor B's price is high. Well, obviously he doesn't agree with investor B, right? When investor B have very optimistic views about market, investor A is very pessimistic. Where investor B is very pessimistic, investor A is very optimistic, right? So investor A obviously think investor B is really a fool. You know, he thinks he's stupid, right? Because I think, when I think this is optimistic, this guy thinks this is so pessimistic. He thinks he's a fool. Well, the other way around, investor B also think investor A is stupid, right? They all have different views, the heterogeneous beliefs about the market. So each one thinks the other one is stupid. What they will do is to sort of play off this other one's stupidity, right? So I will actually buy it when I think the market is optimistic, and try to sell you when you think the market is optimistic, right? So even though in some of my future states, my own view is market is really, really bad. I'm really pessimistic about it. But I don't worry about it because I think there's a fool there, right? There's investor B there who will think really optimistically about the market when I think market will be really bad. So they will each have actual incentive to actually buy the assets and they try to unload to the other stupid guy. And because each of these, you know, they all believe in themselves, they have different beliefs, so their demand for the stock, so to speak, is actually higher than their own valuation. Well, they also play off the other guy's valuation in the market. Right? So that's why when you have short sale constraint, the price can be higher than actually the fundamental because in a sense, the price do not incorporate all the informations, right? Because there's no, you know, when A is really pessimistic, for example, he cannot express his view about the market by shorting the stock. Okay? His only way to actually express his view is to actually buy the stock and try to sell it later. So if A can actually express his view by shorting the stock when he is really pessimistic, then the price can go back to the fundamental. And because of this short sale constraint, all I can do is actually to long the stock, then the market price will be actually higher than either of these things. And although this is like a very simple model, but this is sort of a huge problem in the market, right? Because we know that not all the stocks are shortable. We know that we have short sale constraints. So theoretically, if people have different views of the market, you'll see some valuation deviations, which is on the high side on the market. Okay. So basically, this is how actually I find the solution. Right, so if you look at this red line, This red line is for investor A with D equal to 1. Right, so I am plotting this P1, the price of D equal to 1, against the P0. That's what we're trying to solve, right? In this two-dimensional graph, P1 and the P0. So if this red line is person A, D equal to 1, so which means person A, P1, and this sort of magenta line, purple line, is person B, D equal to 1, right? And we need to take the maximum of these person A and the person B for this P1 value. So we'll pick this magenta line, pick this purple line, because for fixed P0, this line will always have higher value of P1 than the red line. Right, so between person A and B, if D equal to 1, you'll pick this purple line. Similarly, if it's person A and B, so between this blue line and the green line, you always pick the higher one, the blue line. Blue line is person A's valuation when D equals to 0, right? So this blue line and the green line is both the two persons' valuation of each one when D equal to 0. So our solution is where this purple line and the blue line, the two situations we pick, crosses. So that's basically what we're trying to do with this two graph, right? P equal to 1, so we are picking the purple line, which is a valuation of, purple line is the valuation of person B, right? So we're picking basically this expression. If you solve for maximum, this will be the maximum. All right, so for P0, we're picking this one, the optimistic one. So P0, P1, now we don't have maximum operation to actually worry about, then you can solve P0 and P1. And graphically, just this point. As you can see, this is 2.03, and this is 1.8 something. I think this is 1.8446. That's how we actually can solve such a model. Let's take a break, and we'll talk about the sentiment. Okay. So we were talking about the heterogeneous belief and short sale constraint can cause the stock price to deviate from the fundamentals, right? Now, finally, we can talk about sentiment. Remember a couple weeks ago, right, when we talk about the valuation models, we say, oh, the test of the valuation model is a joint test, right? It's a joint test of your model is true, and you have the rational expectation modeling, right? So you can see these anomaly as some proxy for some risk, right? You have risk rational explanation, which is risk-based. Value, for example, is a reflection of the bankruptcy risk. Size can be viewed as a proxy for the liquidity risk, right? So I show you this, equivalence expression with the investor sentiment, right? But there we haven't really talked about, how do we really measure these sentiment? How do we actually use these? Because measure sentiment is actually quite difficult. The main difficulty is that we don't really know what the fundamental of the stock is, right? It's very easy for us to talk about when dividend equals 0, when dividend equals 1, but in reality, it's really hard to actually measure. So that's up to 2006. In 2006, there's a paper by Baker and Wugler. They pointed out that even if we don't actually we are not able to sort of tell the fundamental from the non-fundamentals, the valuation cross-sectionally are very different depending on if the valuation are very difficult to value, difficult to arbitrage, and if these valuations are highly subjective according to the individual's heterogeneous belief, right? And whether those short constraints are sort of more severe in the cross-section of the stocks. So they find that if the beginning of the period, some proxy of the sentiment is low, so I think what they use is sort of the investor surveys, things like that, then the subsequent returns are relatively high for the small stocks, young stocks, high volatility stocks, unprofitable stocks, non-dividend paying stocks, and the extreme growth stocks, including the distressed stocks. So the common characteristics of these stocks is that these stocks are very difficult to value. And these stocks are more subject to heterogeneous beliefs, right? Because if you're talking about a stock of, let's say, GE, or stock of BHP, it's relatively easy to value because they pay constant dividend. You can use dividend model. You know what their business is. You know how much revenue they are likely to actually generate each quarter, etc. Right? But for the young stocks, for the sort of some tech stocks, which is extreme growth stocks, and for the stocks that's during the distress, and for unprofitable spot stocks especially, they're not generating profits now, how actually I evaluate the future prospects of this company. So these stocks are all subject to severe arbitrage difficulties, severe difficulty in the valuations. So people can have different beliefs about these stocks, okay? So for these stocks, when the beginning of the period proxy for sentiment is low, subsequent returns are high. And when the beginning of the sentiment is high, subsequent return is actually low. Why is that? Well, if you think sentiment can drive the price. So if the sentiment is really high, the stocks, these difficult to value stocks, are likely to be overvalued. Right? So if they are likely to be overvalued, then the subsequent return will likely to be low. Right? On the other hand, if at the beginning they are likely to be undervalued when the sentiment is low, then the subsequent return will be actually high. Okay? So although it's sort of difficult to sort of tell the sentiment from the fundamentals in aggregate, but cross-sectionally, we can still see the differences in valuation for these difficult to value stocks, depending on the sentiment. All right, so if you look at the sentiment, this is, I think, largely agree with the big waves in the market, right? So especially if you look at, for example, here, the sentiment is really high, right? And what's that period? That's the dot-com bubble, right? So all those tech stocks are all overvalued, overpriced at the peak of the dot-com bubble. So the subsequent return of these stocks will be extremely low when the sentiment eventually fall down. Right, so the sentiment causes overvaluation, and overvaluation causes the subsequent low returns. If you put this sentiment index with the log moving average of this detrended S&P 500, you can sort of see these two series actually correlated, but not necessarily going the same direction, right? In a lot of cases, they actually go in the opposite direction. Okay, so the newest research on this sentiment thing is that there's a paper by Stembo et al. In 2012. They think all these anomalies we talked about are all negatively correlated with the lag of the sentiment. All right, so for example, we talk about we only talk about value with size, all these, but there's also anomaly about profitability. Highly profitable returns will have higher subsequent profit. There's an anomaly about investment, all these. So they take the principal component of these anomalies and find that the principal component of these anomalies are actually negatively correlated with the lag sentiment. Right, so Baker Wugler relate these to cross-section of the stocks, right? But Stembo relate this to sentiment to the actual anomalies we observe. And more importantly, they show that this anomaly is actually largely driven by the short lag. So the short lag is the lag that's likely to be overvalued. So overvalued, if you short it, the subsequent return is low. So if you short it, you get the anomaly profit, right? So that sort of shows it's sort of the short sale constraint that causes the stock overvaluation in the high sentiment period. All right, so this is just a reproduction of Stembo's point. So if you run this PCA1, which is the principal component, as we show you maybe in lecture 6, yeah, I think it's lecture 6, this principal component of this anomalies, and you run it on the sentiment lag, shift 1, this coefficient estimate is negative 0.47. And that's highly significant. So if you take only the short leg and then run it, you'll find that the coefficient is actually even higher. So that sort of shows the anomaly profit is mostly driven by this short leg of the anomalies. All right, so all these anomalies are sort of formed by long minus the short. Right, so you can sort of study the long leg and the short leg separately. Right? Okay. So now the question is, what are the things that causes these sentiment? Usually, if you want to talk about the fundamental reason for the sentiment, you have to talk about the behavioral biases. As I told you, Robert Shiller got this Nobel Prize in economics. Well, the link changed because it's 2008. Because his research on the behavioral. You can go for the list of the cognitive biases. There's lots of the biases. Okay? So the question for us is not really to go through all these behavioral biases. We'll pick some sort of important ones, and we will talk about whether these biases should actually affect asset prices. So first, some questions. If you observe two sequences of the coin toss, so one is HHHTTT, the other one's HTHTTH, which of the coin toss is more likely to be a fair coin toss? You should be the same. Well, if you hadn't read the explanation below, that means you're more rational than a lot of people. Okay? So a lot of people, when they see these two sequences, they will say, oh, this one looks like you have patterns. The second one looks like more random. But in fact, they are equally random. Right? So randomness doesn't really tell you what sequence really should be. Any of these can be random. Right? So that's sort of the behavioral bias that's called. You can sort of see things that's not there. Or typically, for example, that's very controversial. In basketball, you have this phenomenon of the hot hand. Right, so if you ask a lot of coaches, so who should shoot this ball? They will say Kobe Bryant has shooted it, and sort of gets the score for consecutive 3 positions. He has a hot hand, right? So we should ask Kobe to actually shoot it. But if you look at sort of the long statistics, the shooting percentage of the basketball players, they always convert to their average. So, which means if he sort of missed 3 in a row, that doesn't matter because at some point he actually will hit 3 in a row, right? Or hit in some pattern that sort of converge to the mean. Right. So this is called hot hand fallacy. So this is in investment. You see this also a lot. So for example, how do you actually determine which mutual fund to invest? if you look at the data, the mutual funds that have very good recent performance generates a lot of capital inflows, which means people are putting money in their hands. So it could be, right, these mutual funds have just a hot hand, which means they recently get lucky and have good performance. But that doesn't mean in the long run they will actually have good performance as well, right? So instead of just look at the last couple of quarters, you should look at the whole history of the mutual fund. Hopefully, you know how to calculate alpha and examine that instead of just, you know, see last quarter they actually performs really well. Right. So this hot hand policy can actually sort of generate the hot, you know, sort of what's called the hot money to sort of tracing the recent returns. This is a good one. Linda is a 30-year-old, single, outspoken, and very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. Please rank the following probability. 1, Linda is a bank teller. 2, Linda is a psychiatrist, social worker. 3, Linda is a bank teller and active in the feminist movement. Which one do you think is most likely? How do you rank them? 2, 3, 1. 2, 1, 3. Everyone agree? Well, 2, 1, 3 is not good, not bad choice, I think. %80 to 90% of the people actually rank something like 2, 3, 1. They rank 3 higher than 1. Why is that? Well, they say, you know, oh, Linda's really active when she attended the college, she cares about social issues. Maybe she's a bank teller, maybe she's not, but she must be active in the feminist movement. If she is a bank teller. It's not just, you know, she's a bank teller, it's just too plain. Right? But yeah, so you should actually rank 1 higher than 3, regardless of how you rank 2. That's because the probability of being a bank teller must be higher than the probability of being a bank teller and is active in some social movement. Right? But a lot of people take this similarity in the situation as the probabilities. They're sort of not really thinking about the probabilities when doing the investment decisions. And that will lead to sort of the small sample bias in investment. This is closely related to seeing the pattern that's not there. Okay, so one way to actually model these behavioral patterns is to actually change our utility function. So what's our utility function we talked before? All the utility function we talked before up to this point is the expected utilities. Right? So what's the expected utility? expected utility is you just have probability times the utility payoff, right? And in summation, which is in expectations. Now, for the prospect theory, instead of the utility, which is based on your wealth or consumption, right? The utility is now based on what's called this Vx. And X is not the level of your wealth or your consumption. X is the change. Okay? So it's instead of weighted sum of the utility that's based on the levels, now this is the weighted sum of the utility based on the level of changes. Because from their behavior experiment, they believe people actually care more about the changes, but not the levels when they face the risky decisions. All right, so for example, if you have a gamble that have 60% of gaining $10, 40% of losing $10, if it's expected utility theory, right, then the utility will be 0.6 times the utility of the initial wealth plus 10 plus 0.4 of utility of initial wealth minus 10. That's the expected utility we talked about before, right? Now with the prospect theory value, this will be your subjective probability given that you have 60% of the winning times the utility value of 10 plus your subject probability when this is 0.4 times the utility value when you lose 10, negative 10. So as you can see that this V of x, the x here is just the change relative to the status quo. Right, so that means framing actually matters. How do you sort of face the question? How do you ask the question? What's the situation actually matters, right? So for example, let's say this Friday you want to go to movies, right? And you go with your friend, and at the door of the theater, suddenly you find out you lost your movie ticket. So here's your decision. Do you want to buy another ticket to go to see the movie? Or do you just not see the movie, go back home? Maybe, later on when you think about it, you can go again. A lot of people actually just go home.
No, not me.
Right? Or do you, so people think about this losing the ticket as some loss. And this loss is somehow separate from, I just buy the ticket itself. Right. So importantly, this utility function Vx, it has a kink around 0, which means any loss of this size delta is more important, actually should be more important than the gain of size delta. So any loss, for example, like 2x will be as important as 1x. Loss of 2x was as important as gain of 1x. That's what the kink means. Right? So let me actually put in the graph so you can actually see it better. So this is the prospect theory utility curve. Right? So first thing you notice, there's a kink here. So if you take this derivative and take this derivative on the negative side, you'll see this actually has different slope, right? Which means the marginal here on the positive side is flatter than the marginal utility on the negative side. So people take the sort of losses more seriously. This is sometimes called loss aversion, right? Losing $1 for you in terms of utility is equivalent to gaining, for example, $2. You just hate losing, okay? The other feature here is that if you look at this is concave, right, on the positive side. So if this is the concave, this is actually risk averse, as we talked about at the beginning, right? But on the negative side, this is the convex. So which is opposite of concave. So if this is the concave is risk averse, then the convex is risk seeking. Right, so why is that? So when people sort of face these games, they behave like they are risk averse. When they face the losses, they behave like they are risk seeking. Do you remember when we talked about expected utilities, we talked about some violations? Right, so one violation is when there's a sure loss and some probability of the losses, people actually choose this probability of losses although the expected value is lower. If you go back to find out that example, right? So people hate the sure loss. If instead of sure loss and some gamble, they will choose gamble, even if that means expected utility is lower. That's basically what the convex utility means here. All right, so the loss aversion means that people are indifferent, for example, between status quo and 2/3 chance of gaining 10 value and 1/3 chance of losing $10. So expect the value here is positive, but still they are indifferent. Right? Or between the status quo and same probability, but the payoff is 20 and -10. So again, the expected value is positive, but still people are indifferent from the status quo. So with this loss aversion, it's no longer true as we talked about in the expected utility theory, the sort of the small, really small risk doesn't matter in the first order. It's only matters in the second order in terms of risk aversions, right? Now, the really small risk matters by itself. Not just in the second order, it's also matters in the first order. Because immediately you see the differences between the gains and the losses. In expected utility theory, you treat the gain and losses equally, except from the convexity, from the concavity of the utility, right? So the loss aversion will really discourage the trade. So if you, for example, we talked about the participation problems, right? So in participant problems, if you take the expected utility theory, the participant decision should be determined only by the expected marginal utility, the marginal returns, right? So expected return, if it's positive, you should participate regardless, right? But we see that empirically, that's not true. So one way to sort of explain this phenomenon is that people possibly have this loss aversion, which makes them to see the losses more important than the gains. So if you sort of use the prospect theory utility function with this myopic loss aversions to do the asset pricing, asset allocation problem again, right? So remember the asset allocation problem, we have faced this for many times, right? The typical value we get is about like 60%, right? Now, if you do the simulations, the maximum is actually happens somewhere here, right? So that's the maximum is about 30% that maximize your utility curve with the loss aversion. So with loss aversion, the asset allocation will be much lower compared to the expected utility. So the question is, do we actually have evidence on those loss aversions? All right, so in general, there's a lot of behavioral experiment that's done to find out that people are actually predisposed to get even. Right, so that's why in casinos, you see people are actually harder to get off the table. Right, so once they lose some money, they always want to have one more play to try to get even because they hate the losses. Right, so this is the disposition effect, which investment implies that people have propensity to lock in the sure gains than to lock in the sure losses. Do you observe this? You observe this a lot with individual investors. If they have the temporary nominal paper loss, what they do is to try to wait out, right? Hold the stock at the wait. If they have the gains, a lot of times what people do is to, oh, I already have 10%. Let me actually sell it before the stock price goes back down. Right, so if you look at how the individual investors trade, they do this a lot. Lock in the sure gains instead of locking the sure losses. So one sort of paper to address that is the 2001 paper by Odin. He found that individuals are more likely to sell the stocks that have risen in price rather than those that have fallen in prices, which means people do not treat the gains and the losses symmetrically. All right, so if you look at this table 1, you have two variables, the proportion of the gain realized, PGR, and the proportion of the loss realized. If you look at the entire year, PLR, the loss realized, is 0.098. Proportion of the gain realized is 0.148. So the proportion of the gain realized is much higher than the proportion of the losses realized. Okay, so if you have losses, you tend to hold the stock, not realize it, because you realize it only when you actually sell the stock, right? But if you have the paper nominal gain, then you try to realize it. So this is actually much, much higher. The only difference is in December. That's because in December, there's a special advantage if you realize the losses. Do you know what's that advantage? Christmas, so you lose your money and buy the.
The stock so that I can get some money to buy the presents I need.
Oh, you mean the liquidity?
Yeah.
Okay. Well, maybe, I don't know. But that's not the typical incentive. I think the typical incentive, well, most of the people who actually sell stock wouldn't have money to, Christmas gift, we're talking about maybe like a couple $100 maximum. Why do you need to sell your stock to get a couple $100, right? So I think that situation is rare. The real motivation is tax. Because I think Australia is the same. In the US, if you have capital losses, you can deduct your taxes, right? If your investment has losses, you can pay less of the tax. So what people try to do is to realize your losses at the end of the December. Then if I need, I can buy it back on the January. So that's also, if you look at the historical stock returns, generally have higher returns in the US stock market. All right, so this is driven by tax considerations. Well, the question is then, are they justified to do that? If you look at the average performance in the next quarter, 84 trading days, and the next year, 252 trading days, the average excess return on the winning stocks sold is much lower than the average stock. It's much higher than the average excess return on the paper losses. So this one is higher than this one is higher than this one. What does that mean? That means, remember, people are selling the winning stocks, right? When you have gains, you try to realize it. But after you sell the winning stocks, the returns are actually higher. So that's this 0.0047. And in a year, about 2%, 0.0235. So you are sort of foregoing at least 2% annually by selling those winning stocks. But if you are sort of continue to hold the losing stocks, so this is average excess return on the paper losses. If you continue to hold the losing stocks, as we observed, the performance in 84 days is negative 0.0056. The performance in the next year is about 1% loss. So people are selling the winning stocks too quickly and holding the losing stocks too long. Because those losing stocks continue to be losing. All right, so this is, I think, one of sort of the biggest problem with the individual investors. If you go to, anywhere, this is the US market. If you go to the Chinese market, this phenomenon is most likely to be worse. Right? And an additional implication of that, people actually trade too much. Right, so a lot of if you look at individual investors, very few of them actually, on average, earn money, but they like to trade a lot. The trading is harmful to your stock performance for the individual investors, because they are only looking at, sort of driven by the most recent returns of the stock. The other aspect of this because we talked about behavior, all these, right? The other aspect of this is the market structure and informativeness of the market might be different given people enter or leave the market. So for example, if you look at the profitability of the momentum strategy, that profitability declines sharply with the firm size, which means for really large firms, there's not a lot of momentums. But if you hold the size fixed, momentum strategy works better among stocks with low analyst coverage. What does that mean? That means with not a lot of public information, the information is realized in the stock returns more slowly. Okay? So if the information is realized slowly, then you have momentum. And the effective analyst coverage is greater for stocks that are past losers than for the past winners. Why is that?
Losers are focused more by the investors.
So think about, for example, we have short sale constraint, right? Let's say everyone can only buy, cannot short. So if you are losers, that means a lot of people actually sell the stock, right? Once they sell the stock, these people's information is not relevant anymore. Unless they have good news and they sort of go back to buy the stock. If they have bad news, they cannot sell it again because they already sold it. They leave the market. Right? So people leave the market after a prolonged period of price declines. They sort of, if someone sort of continue to hold the stock as individual stock investors, but when they continue to hold the stock, that's driven by their behavioral bias. They're not really looking at the stock, right? All they look at is, well, I still have losses. Right, so especially the negative information that people could receive with those who leave the market is not reflected in the market anymore. Right? And in other words, the market attention is really low when the stock price decreases. And because the market attention is low, the information that's reflected in the stock price will also be slow. Right, so this is why I titled this "Bad News Travels Slowly." Okay, so we talk a lot about these behavioral biases. We pick the typical models, especially emphasize on the loss aversion and the prospect theory, right? But as I show you, you can have all sorts of behavioral biases. But the question is, are these biases enough to actually move the market price? Right? After all, the asset price or stock price should be determined by what's called the marginal investors. The investors, they are actively trading, right? So as long as we have a bigger proportion of smart investors, even if a proportion of us are sort of behavioral biased, that may not be actually enough to actually move the market. For example, when I ask you guys seems like more rational than 80% of the behavioral subjects. You made your choices sort of more rational than others, right? So although there's behavioral biases in the market, that doesn't mean automatically the market should be sort of biased, subject to the behavioral bias. As long as they are sophisticated investors, sometimes we call these smart money, right? Then this arbitrage by the smart money, by the sophisticated investors, should bring the stock price back to the fundamental. If short is possible, and all that, right? But when is the case that the behavior bias can actually limit the equilibrium stock price, affect the equilibrium stock price? That should be the situation when there are actually limited arbitrage. So even if there are actually smart money out there, even if you are sophisticated investors that do not subject to those behavior bias, but you cannot do your arbitrage in limitless ways. Number one reason is that your capital is limited. Right? So the market, for example, can be getting worse before it getting better. There's this famous example of during the dot-com bubble, there's this fund. I can't remember the name, maybe Tiger Fund or something. This fund, this fund was really run really well, and they were actually absolutely right about those tech stocks, right? So they go actually shorting Amazon, shorting Yahoo, shorting all those tech stocks during the bubble. But bubble runs from, I think, 1999 to, I think, throughout 2001. So it crashes eventually, but when the market actually crashes down, before the market actually crashed down, their hedge fund went bankrupt because they no longer have enough capital to support their shorting. Right? So you can do your arbitrage, but your arbitrage is still subject to your limited capital. Right? So although we talked about arbitrage, sort of one of the most fundamental assumption in finance, but you should realize that in reality, sometimes the law of one price actually got violated. Sometimes the arbitrage is limited because you have this capital issues, right? Then you will say, oh, well, maybe this fund doesn't have the capital, but why can't he borrow the risk-free rate? Right? I mean, in theory, he can. But if you are investors who actually see their performance, their shorting of the stocks, that's sort of losing 50% of the capital, are you confident to actually invest in put the capital in that fund? Absolutely not, right? So if you watch this movie, there's this movie that's called Big Short or something about this financial crisis, right? So this guy is a fund manager, right? So I think all sort of his clients are beginning to pull the money. There's this scene, he's checking the emails, right? And all his clients are sort of pulling the money at sort of the height of the crisis. He's just beginning to sort of earn money, right? But clients doesn't believe him. They want to pull the capital instead of putting the capital to him. Well, eventually he earned billions, right? And I think that experience, he eventually no longer do any hedge fund. I think he now is managing his own money only. He just hates the clients. Right? So why the behavioral factors matter is because you could have situations with limited arbitrage. So even if there's smart money out there, smart money is not enough to actually bring the price to the fundamental value. And that's it for today.
它应该准备就出来，准备出来。对，就是它出现一个什么 index out of bounds， 这是。
应该就说明你这个 regression 写的不对呗。
这样啊。
啊。
这是哪里错啊？
这个，对，这个可能就因为你用了这个 group by 以后不能这么做。
啊，那要怎么样？
你应该用一个，similar 的这个 function， 但不是 output 的这个东西。
那我 output 要similar， 就是还是这个 function。
对。
那我的 output 应该要怎样
？output， 我觉得是因为它这个 parameter 这边是有对吧？就是你有这个需要2个 parameter。
对啊，然后呢？
你自己先再去试一下，不行再来问我。OK。
就是 regression 我不太懂啊。
我觉得对啊，但是这个应该是自己可以解决的。我要去给他们那个。他们下面有节课那个 presentation。
那个8100吗？就是你再点一下，就是大概是哪里出了问题？
大概就是你要把这个 regression function 的 output 写的不一样。
不一样，那可以再详细一点，就大概是哪个地方出了问题
？There's other ways. For example, 就是它这个不 take 这个 parameter。
就是它这里，就是我这个。
对，就是这两个 parameters 这样弄进去，它这个不 recognize。
那我可不可以自己就是直接手动打一个 function 出来，就是把它 group by， 然后直接手动把那个 function。